If you're like me, you probably feel like time is flying. It's hard to believe, but we're already past the halfway mark for 2024. For those investors clipping coupons, the bond market has treated you well so far. But looking at the second half of the year, what could potentially fuel further upswings in the market? We're going to break that all down for you right here on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us today. My colleague from the Chief Investment Office, Leslie Falconio, is here with us to break down the latest of what's going on in the bond market. Leslie, good to see you. Certainly, it's been a very interesting bond market, to say the least, not only just in the last 6 months, but really in the last week or two, considering we got some jobs numbers that really kind of sent Treasury yields declining on the 10 and 2 years. So what's going on? What's the market pricing in? What are you seeing right now as far as activity in the bond market recently?
Well, I mean, actually, Anthony, we've been really sort of stuck in this range of 10-year Treasury yields from that 4 and 4.5%, and you actually could play that range fairly tactically. But to your point, I mean, we have seen a bit of weaker data, starting with the employment report. A 4.1% unemployment rate is the highest that we've seen in 2 years. We had ISM services below 50, which was a bit contractionary. And while things like the job openings improved a little bit, there's no question that the economy is slowing as we expected, albeit above trend. But one thing that we are focused on and looking at, although not necessarily the most perfect indicator, things like the Atlanta Fed GDP now it's only coming in at about 1.5, 1.6% for the second quarter, although consensus is 2.2. A lot of information is still to be had, particularly this past next week or this current week when we have things like CPI coming out, and then obviously the Fed at the end of the month. But there's no question the debt has been softening a little bit, and I think that's being shown in the Treasury market, coming down from that upper level of 448 that we saw the day after the debate.
Yeah, exactly. And as we're sitting here, Leslie, the 10-year is about a 4.3 or so. And as we just talked about, when the jobs numbers came out, and it was, well, unemployment was a little higher. The jobs numbers themselves, payrolls were a little higher. But it was almost that sweet spot when it looks at when people think about, okay, what's the Fed going to see? And it looks like traders are starting to price in potentially two 25 basis point cuts before the end of the year. So when you look at the data overall, what does it actually mean to you when you're looking at the back half of the year for bonds, if we can assume that the Fed is going to cut rates?
Well, look, I mean, to your point, we expect, two 25 basis point cuts as well. And now we have about an 80% chance of September being priced in after that employment report. Again, this week's inflation number could alter that a bit, but more than likely, there's going to be two cuts this year. But really, what the focus is now is what is it going to look like in 2025? And that's really what the market is pricing in. Because what had happened was after the summary of economic projections and the Fed took out some cuts in 24, they pushed it into 2025. So in 2025, the market is now pricing in about 95 basis points of cuts, or close to 100 basis points of cuts. And that is really where the bulk of the cuts will occur, on the assumption that we still get this disinflation trend, even though it might remain above the Fed's inflation target of 2%. We still have slowing growth, even though it'll be above trend. But really, the market is pricing in not just the two cuts that in 2024, but they actually added another cut for 2025. So what this has done is that when we think about the shape of the curve and what we look at, how we think the shape of the curve will progress going forward, and you and I have talked about this before. Listen, the curve has been inverted for 2 years. So regardless of how the election outcome results, the curve is going to normalize. The curve is going to steepen. Now the steepening actually will be meaning the short end outperforms the longer end. The question becomes, does the steepening happen in an environment where rates are declining, or does the steepening environment happen where rates are increasing? We happen to believe that the steepening is going to happen with rates are declining. We have a year-end forecast of about 3.85 10-year yield, and probably about 3.5 in 2025 as the Fed sort of expedites these cuts. So we have what is called a bull steepener. So we think the curve starts to normalize after 2 years of inversion, but we think this happens with the short end outperforming, but with yields coming down.
It's interesting. We talk about the yield curve quite a lot, and you really made a very strong point there, Leslie. It's a record number of years. It's over 2 years that the yield curve has been inverted. Why do you think investors are, I don't know, would you even call them spread agnostic? What do you think that they see when they see that inverted yield curve for 2 years. It's almost like normalizing that that's the way it should normally be, even though we know that that's not the normal case.
Yeah, and I think that's a great point, Anthony. I mean, we have our fixed income strategists coming out at the end of the week, and we're going to talk about the second half outlook. And I think people being spread agnostic is really is on point. Look at the Bloomberg Financial Conditions Index. Last week, it was the loosest or the easiest it's been in the past 27 years. So that kind of loosening of financial conditions as the economy is slowing is number one. The investor view that this is a resilient economy and it'll stay resilient when you look at consumer and corporate balance sheets. And two, look how well the equity market is done. Look how much cash is on the sideline that needs to be put to work. So when we think about how we want to allocate in terms of that, people aren't looking at like, what is the spread on high yield and the fact that it's at the 10th percentile over 25 years, meaning that 90% of the time spreads have been wider over the past 25 years than they are today. They're just looking at that yield. And now there's no question when it comes to the driver of total return, it's not your spread, it is your yield. It is that compounding income. It is that carry that's a driver of total return. But that doesn't mean at this stage of the cycle you want to ignore where these spreads are. And what's happening is because there's such a consensus of resilience in the economy, because the economic data, while softening, is still proved fairly strong, as you point out, the labor market, and still pretty resilient. They really have to see this sort of slowing, going forward. And this is still a data dependent Fed. This is still going to be a data dependent market, which is why you might see a little bit of volatility when we talk about this curve. But for our purposes or for our outlook, we really do like, given the stage and given the fact that spreads are compressed, we do want to stay with this, higher quality things like MBS, agency MBS, IG corporates, all those kinds of sectors that give you the ability to have price appreciation while earning a little bit of incremental carry outside of just U.S. Treasury rates, and recognize that now is not the time to be complacent, and now is not the time to be necessarily spread agnostic, given where we are in the cycle.
So, what are the risk factors that are out there right now, Leslie? As you mentioned, we have the election coming up. There's always a risk that the data, meaning inflationary data or jobs data, could go completely back in the other direction again. Maybe unlikely, but still quite, it's still a possibility. What would you say are the risk factors right now when investors are getting into fixed income, they're clipping coupon? What do you say?
Listen, there's two types of risk. There's one that pose a short-term knee-jerk reaction, right? That kind of risk, and we saw that post debate, right? The 10-year Treasury went up 20, 25 basis point immediately. You had huge, what we call a bear steepened with rising interest rates, right? Because as we know, people look at sort of like a Trump as inflationary with tariffs. This fiscal deficit that we have, everything that's sort of would lead to not just a steepener, but a bear steepener. I mean, rates are higher.
Mm.
But as we saw that knee-jerk reaction, once the fundamentals came out in that with that employment report and the 4.1% unemployment rate, it gave it right back. So one of the things that we have to look at is a short-term knee-jerk reaction and some of these longer-term fundamentals. And what the risks are, because the economy and because people view the economy as resilient, as do we. I mean, CIO is not looking for a hard landing. The risk is it slows quicker than what people are anticipating, particularly when you have both sides of the spectrum of risk assets, equity and fixed income, far from cheap, right? They're both fairly, I wouldn't call them cheap right now. That doesn't mean they're going to have material corrections, but you're not at a starting point where we were at the beginning of the year or before the December FOMC meeting of December 2023, and we started this sort of financial conditions loosening trend that has continued throughout the year. So those are really the biggest risk factors. So the good thing about fixed income and the good thing about the higher quality fixed income is the cushion you're provided from earning that compounding income. And because of that, it really does give you a fairly wide variance in terms of how much spreads can widen. But you just really need to select your spots, because not everything is doing great in lower credit quality. We've talked about this in high yield, that triple C's are underperforming. That's why the diversification of your portfolio is really important. To have some high quality, definitely have that yield and carry. I mean, we're neutral within lower credit quality. We're not underweight, we're neutral. But we just think at this stage, you're the prudent risk reward is for some of the higher quality sectors, particularly given the risk is that the economy slows more than anticipated, or even in the scenario where the curve really moves higher, yields move higher, and the curve steepens. That's not going to be a great tailwind for total return for either sectors, as we go into 2025.
Great. Leslie, thank you very much. Good to have you join us.
Thanks so much.
Great. Thanks again, Leslie Falconio from UBS's Chief Investment Office. And for more information on all the content that Leslie is creating, as well as our other colleagues in the CIO, visit our website at ubs.com/views. That's our insights page. Plus, you can also follow UBS on social media. We're on all the major channels, including Instagram, where you can follow us at UBS Trending. Lots of studios content on that page for you. And as always, if you have any questions about anything that Leslie and I spoke about today, make sure that you are speaking with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.